Well, good morning, everyone, and happy spring. Thanks for tuning in with us today. My name is Mike Citrick, and I'm EVP for Advancement at DuPage Foundation. On behalf of my colleagues, our Board of Trustees, and Professional Advisor Committee, it's a pleasure to welcome you to the latest installment of our continuing education series for professional advisors. We've got a great program lined up for you today with an outstanding presenter. Before we get to that, just allow me to share a few housekeeping notes and a little about DuPage Foundation for those of you joining us for the first time. Today's webinar will be recorded and made available along with slides. Our continuing education credit is being provided free of charge for those who've registered with us and are eligible for it in accordance with our various accreditation providers. However, you must be watching live and stay logged into Zoom for the full duration of the program. You'll also need to complete a short electronic evaluation provided at the conclusion. Specifically, we'll be offering 1 hour of CPE credit for Illinois CPAs, 1 hour of professional responsibility, professionalism credit for Illinois attorneys. 1 hour of CE credit is available for CFPs. And then we have 1 hour of ABA approved CE credit for CTFAs. Feel free to contact us at the email provided in the chat with any questions about eligibility. Kate Balswitz, our Assistant Director of Donor Services, will field that. For questions about the program itself, we invite you to submit them throughout the webinar utilizing the Q&A feature at the bottom of your Zoom window, and we'll address them during the question segment at the end of the hour. So really quickly, just a quick word about DuPage Foundation. DuPage Foundation has been serving our community for more than 35 years, and we are DuPage County's philanthropic leader. You can think of us as the engine that drives charitable giving throughout DuPage County, helping our residents do a world of good in their own backyard. And we do that in 3 ways: by helping people and organizations give efficiently and effectively to the causes they love, providing vital support to our community's not-for-profits through our grant making and various initiatives, and fostering key partnerships to address critical issues affecting our county. Since our inception, we've granted more than $65 million on behalf of our community and beyond. And locally, our grants are doing some amazing things to address the needs of our most vulnerable neighbors and to raise the quality of life for all of our residents. But most importantly, we're here to be a resource for you and for your clients to help them discover and unlock their charitable potential. We're local, we have deep knowledge of the charitable landscape, and are staffed and governed by some of the most dedicated folks you'll find. So I invite you to call on us when you need help. Turning to today's program, we are honored to have one of our country's leading authorities on charitable planning with us, Dr. Russell James, above me in the window here. For those of you unfamiliar with Dr. James, he is a JD, a PhD, a CFP, and currently serves as the chaired professor for the Department of Personal Financial Planning and the director of the graduate program in charitable financial planning at Texas Tech University. Dr. James has an incredibly distinguished bio, but in particular, I just want to note that he's authored several books on fundraising and charitable planning, and has been published in more than 75 peer-reviewed journal and law review articles, as well as being quoted on charitable and financial issues in a variety of news sources, from The Economist, the New York Times, Wall Street Journal, CNN, and the Chronicle of Philanthropy, to name a few. So without further ado, my pleasure to welcome Dr. James. I'll turn things over to you.
Okay, thanks so much. Appreciate that. And I'm looking forward to sharing some ideas with you that I think you might find valuable as we have opportunity to take a look at some different strategies and plans in the space of charitable planning. Now, starting out with this grumpy-faced looking teacher, this is the way that I feel internally when I'm teaching these things. But you have to understand, I'm used to teaching graduate students where I just tell them this is the way to do it. But we're not in that same kind of relationship. Unfortunately, I'm not allowed to flunk you. You still get the CE regardless of your experience this morning. So I guess I would just call this maybe the top 10 ideas or suggestions for you for helping your clients and your business with charitable planning. So we're going to take a look at these top 10 rules. We'll look at each one in turn, but let's start with rule number 1. So rule number 1 is going to be something that, well, if you were representing a nonprofit, you might feel like it's a pretty scary rule, but it's actually not. That's the rule of never give cash. Now, why would we say never give cash? Well, this is very simple. And actually, what we're going to do today is start out with really simple concepts. We're gradually going to get more and more complex as the hour goes along. So the simple concept is this: if I write a check to a nonprofit organization, the benefit that I can get out of that is a tax deduction. Now, if I'm itemizing, I can use it. If I'm not itemizing, then I can't use it. But if I make that same gift, not from cash, but from appreciated assets, say some shares of stock that have gone up in value, I not only get a tax deduction of the same size, but I also get to avoid paying capital gains tax on that. So I can get a tax deduction for the full value of the appreciated asset as long as I've owned it more than a year, and I can avoid that capital gains tax. So let's look at a really simple example to make that quick comparison. Let's suppose I write a gift for, or I write a check for, let's say, $10,000 of cash. Well, that $10,000 check, I can get a $10,000 tax deduction. If we're just looking at the federal taxes, if I'm at the top rates, that's worth $3,700. So my net cost drops down to $6,300. If, however, let's say I've got some shares of stock that I bought for $10 a share, it's now worth $100 a share, and I give that instead, I not only get a tax deduction worth $3,700, but I get to avoid paying capital gains tax on that $9,000 of capital gain. Sorry, the slide there should read $10,000 of cash transferred rather than $100,000, to try and keep the numbers round here for an example. And what you see is that that reduces the cost of the gift even further because I'm avoiding those capital gains tax. Now, by the way, this is particularly important if you have clients who are not itemizing, because they can't use that tax deduction, but they can still use the avoidance of capital gains tax. So regardless of whether they're itemizing or not, they can still use tax avoidance even when they can't use a tax deduction. This is a way, by the way, an important way to bring up this topic with clients. If a client mentions that they're making charitable gifts, but with that high deduction since the 2018 tax law, they can't use that charitable deduction, there is still a way that they can get a tax benefit from their giving if they give appreciated assets. Now, I've mentioned that appreciated asset gifts are cheaper than gifts of cash. That has become even more so the case in states like Illinois that also charge state income, state capital gains taxes. And here's the reason why. It was always useful to be able to avoid those state capital gains taxes or state income taxes. However, that became even more powerful now that most of our clients are going to already be capped out from using those state and local tax deductions, probably already capped out just from their property taxes, they're paying various other taxes, meaning that those state income taxes and capital gains taxes are more painful now than they were before 2018, because in many cases, they're not able to be deducted at the margin from the income tax returns. Since they're more painful, well, avoiding those now more painful capital gains taxes is even more important. And here you can see the impact of that for the 4.95% rate. So that's the first suggestion, is never give cash. The second suggestion is an even more powerful extension of this, which is to use the charitable swap. So one of the things that's really important to keep in mind is, let's say you're talking with a client and you mentioned the attraction of giving appreciated assets rather than giving of cash. And they say, yeah, I've got those Apple shares that have gone up in value, but I want to stay invested in Apple. I'm not ready to sell out yet. So I'll wait until the future and I'll just make the gifts in cash for right now. Well, here's the reality. You don't need to change your portfolio at all. You simply use the cash that you were going to have donated to charity. You donate instead the old shares of Apple stock and you use that cash to buy brand new shares of Apple stock. Your portfolio doesn't change at all. You still own the same number of shares after as you did before. The only difference is you have wiped out all that capital gain from your portfolio. You give the old shares of stock to the charity. You buy the brand new shares of stock with the cash that you were going to have donated, and your portfolio stays the same. Now, very important to keep in mind, we can do this transaction at the same day, at the same moment. We do not have to go through a waiting period because we're not worried about the wash sale rule here, because this is gain property, not lost property. We would never donate lost property. If we have lost property, we want to sell that, take that valuable tax loss to use it in other places. We would never donate lost property. We only donate gain property. But because this is not lost property, we are able to do this immediately at the same point. Now, one of the things also to keep in mind is that we might say, oh, I don't need to worry about wiping the capital gain out of my portfolio because I'm not really planning on selling it. I'll just hold it all the way through to the end of life, and then my heirs will get it with stepped up basis. Well, there's two reasons why that's not an ideal strategy. Number one, you think you're not going to sell it, but you don't know, right? Things can change, investment opportunities can come along, whatever might happen where you may need to sell it. So why not wipe out the capital gain tax? And here's the other reason. Even if you do execute on that plan and you hold it all the way through to the end of life, are you willing to bet that Congress isn't going to change that stepped up basis rule for inheritance? And we're certainly talking a lot about that in the fall. Why make that risky bet when you can simply wipe out the capital gain from the portfolio today? Now, by the way, this is where donor advised funds, such as those offered by your friendly neighborhood community foundation, can become very powerful, because this makes it simpler, this makes it easier. And many times you might have a client that is giving to smaller or unsophisticated organizations, maybe a church or synagogue or a mosque. They don't really know how to accept a gift of securities, like, oh, there's this medallioning process and how do we transfer the certificate and all of that. You can avoid all of those hassles by simply using a donor advised fund. We do this same charitable swap. We ship the old shares that are appreciated to the donor advised fund. That donor advised fund can then sell them. There's no capital gains tax because it is a charitable entity. And then the actual cash gifts simply go out to the various charities that the donor is interested in. So this makes it really easy, really flexible. We can do this at any point. And then we can simply advise those grants going to the various charitable organizations along the way. So again, a free tax benefit we give up every time we give cash instead of giving an appreciated asset. So if we have those assets to give, we want to give those, do the charitable swap, keep the portfolio the same. So that's the second suggestion. The third suggestion is to learn bunching and some other new tricks that started in 2018. So what's the idea of bunching? Well, of course, 2018 is when we got the big increase in the standard deduction. That big increase in the standard deduction means fewer people are itemizing. For people who are not itemizing, those charitable deductions are not valuable. They're not using them. So let's suppose we have someone who has that $12,500 standard deduction for an individual, and each year they make $10,000 of charitable gifts. What is the tax benefit from doing that? And the answer is there is none. There's no tax benefit because, in fact, every year it's more advantageous for them to take the standard deduction. However, we can take a strategy of bunching those gifts. Let's instead, if we've got some financial flexibility, in the first year, go ahead and stuff all 4 years worth of giving into our donor advised fund. We take the large tax deduction in year one for all $40,000. We can then get an advantage of that because that's more than the standard deduction. And then, of course, in the subsequent years, we'll just be pushing money out of the donor advised fund. That doesn't generate any tax deduction. In those years, years 2, 3, and 4, we're just going to take the standard deduction. So we're not worried about generating any additional deduction. So this is just the example of how we can bunch that giving into the big years. And of course, the best way to do this is not necessarily just by writing a check to the charity or the donor advised fund, but of course, by doing the charitable swap, where we when we're making that big transfer to fund those future years of charitable giving, we make that transfer into a donor advised fund. And by the way, in the meantime, those assets, which we can continue to manage and invest, those assets are going to be growing completely tax-free. So we can get some benefit in terms of the impact that we make with those ultimate gifts. Just a quick note, there was a lot of negativity on the 2018 tax law in terms of charitable impact because fewer people are itemizing. But I would point out some really big advantages for charitable giving that came along with that tax law. The number one biggest advantage is the elimination of that P's limitation, which prior to 2018 was wiping out up to 80% of the charitable deductions for some of our high income clients. And that went away. As we've already seen, the states that have their own income and capital gains tax, like Illinois, because of the SALT caps, it makes those tax deductions even more valuable because avoiding state taxes now becomes more important because they're more painful. And we also got an increase in the income limitations where we can now wipe out 60% of income with gifts of cash. And so that can be very useful as well. If we exceed that, then we can carry those over for up to 5 additional years before those need to be used. And now let me get really tax wonky here. Just a little side note in case you ever happen to have a client who is in this particular circumstance. You may recall that with the 2018 tax law, we got this new 20% deduction for qualified business income. Now, qualified business income deduction phases out at higher taxable income levels for certain clients. Here's something really important to keep in mind. Unlike essentially every other tax benefit that we have in the tax code, which tends to phase out at different levels of adjusted gross income, this weird thing phases out at different levels of taxable income. Why do we care about that? Well, we care about that because taxable income is what you have left after you take your charitable deductions. So what does that mean? Well, let's suppose you have a client who qualifies for the qualified business income deduction, but because of their higher taxable income, they have phased themselves fully or partially out of that qualified business income deduction. If we know this in advance, we can make charitable gifts to phase them right back into that qualified business income deduction, especially if it's somebody who's generally charitable, and we may just go ahead and use a donor advised fund. We'll go ahead and stuff that money into the donor advised fund this year to take that deduction so that we can pull down that taxable income. So we essentially get a double bonus from our charitable giving. We get the first level of benefit, which is, hey, we get a tax deduction. We get the second level of benefit because not only do we get a tax deduction, but because taxable income is dropping, we then phase ourselves back into that 20% qualified business income tax deduction. So if you happen to have a client who is a charitably inclined person who you've noticed, oh, they are on the verge of, or they have just passed phasing themselves out of the qualified business income tax deduction, we can consider that option of let's go ahead and stuff some money into a donor advised fund to sort of pre-fund our current and future charitable giving so that we can take advantage of that double bonus that we get from phasing ourselves back into the qualified business income deduction. So a wonky little way there that we can bring back the qualified business income deduction from the dead by using charitable deductions. So that's the third set of suggestions, which is to learn bunching and other new tricks. And let me mention as we're going through here, please feel free if you have any thoughts or comments, objections, snide remarks, whatever comes to mind, please put those into the chat and then at the end or the Q&A and at the end we will make sure and get to all of those. The fourth suggestion is to give retirement RMD first and more at death. So let's look at what you already know, just a quick refresher. There are life stages of a retirement account. There's early distribution before age 59 and a half. Typically don't want to do that because unless we qualify for one of the exceptions, of which there are many, but if we don't qualify for one of those exceptions, we not only have to recognize that income, but we got to pay a 10% penalty for taking it out. There is then the regular distribution period between 59 and a half and 72. And then once we're at 72 and above, we've got that required minimum distribution where we're forced to take that out. Now, we could, after age 72, we could take that income out. In fact, we do have to take it out. Otherwise, we've got to pay a 50% penalty, which is really brutal on any of that required minimum distribution that we don't take out. And if we wanted to, we could turn around and we could then write a check to the charity. Now, it is theoretically possible in a rare case that those things might completely offset, but they almost never do. Why is that? Well, to begin with, of course, the client would have to be itemizing, and there needs to be no income giving limitations exceeded, and there needs to be no negative effects from increased AGI, which can affect all sorts of other things, from how much they're paying for Medicare Part D to various other tax benefits that get phased out because of that higher AGI. And so because of that, the strategy we always want to take is to make that transfer directly to the charity from the IRA. So a qualified charitable distribution eliminates both the recognition of income and the deduction. This is particularly fantastic for any clients who are not itemizing, because again, even if we're not itemizing and can't use a tax deduction, we can still use tax avoidance, which is what this is. We are avoiding recognizing that income. We are avoiding paying those taxes by making the transfer directly to the charitable organization from the IRA or IRA rollover. Now, do keep in mind that although our required minimum distribution age changed to 72, our qualified charitable distribution age did not change. So we can begin to do this at age 70 and a half. So we've got money that we've never paid income taxes on. Now we can start shipping it there at age 70 and a half, start shipping it to the charity to make our charitable gifts that way. And we engage in tax avoidance. We now never have to pay income taxes on it. If you have clients age 70 and a half who are writing checks to charity and they're not deducting those because they're not itemizing, this is a much more tax efficient way for them to be giving even before those required minimum distributions kick in. So a couple of things to keep in mind about the qualified charitable distributions. First, these come from IRAs or IRA rollovers only. So if you have a 401k, a 403b, different kinds of these accounts, you first have to roll it over into an IRA rollover, and then you can make the qualified charitable distribution. Let me warn you though, there's a trap, and a lot of people get caught into that trap. And the trap is this: if you wait too long to do the rollover, once your client is in that year when they're going to turn age 72 and they have a required minimum distribution, you can't avoid the required minimum distribution for that year. because one of the requirements of doing that rollover is to pay out that required minimum distribution in the year that you convert that account to an IRA rollover. You can't get out of that because you can't pay qualified charitable distributions from these other accounts. So the thing to do is, if you've got a client who may be interested in doing this type of qualified charitable distribution, go ahead and do that rollover before we get to age 72, so that you don't get stuck with that first year required minimum distribution. Go ahead and convert that now into an IRA rollover. And frankly, since we can start using these at age 70 and a half, might as well go ahead and roll over early, just in case that desire to write a check to the charity, if they're not itemizing, comes up, and we'd say, no, don't write the check that way. Just ship that money out of your IRA. That way you engage in tax avoidance, even if you can't use the tax deduction. Now, we do have some additional rules that started up where if a person is actually after age 70 and a half, if they are making new contributions to the IRA that they are deducting, they're going to have to burn those off first before they can start using the qualified charitable distribution in this tax advantaged way. We'll talk a bit more about that in a moment, but basically the IRS didn't want the same person to be able to be stuffing money into the IRA, taking those deductions, above the line deductions, and simultaneously sucking that money out of the IRA through a qualified charitable distribution, because that amounts to an above the line income tax for charitable distributions. A few other things to keep in mind. One, this is a $100,000 per person maximum. Notice that maximum has nothing to do with the RMD. It's always $100,000, even if you do it at age 70 and a half when you have no RMDs, or age 71 when you have no RMDs. It's still $100,000 per person maximum. And you do have to send this to a real live charity. That is a real live functioning public charity, operating charity. You can't send it to a private foundation. Unfortunately, you can't send it to a donor advised fund, a charitable trust, or a charitable gift annuity. So just to sort of drive the point home a little bit, how much can a donor age 70 and a half, or say a donor age 72, transfer versus via a qualified charitable distribution? They have to be 72 to have RMDs. But here's the hint. The answer is always $100,000. So don't get confused here. If their RMD is $25,000, if it's $0, if it's $200,000, if it's $2 million, the qualified charitable distribution cap is always $100,000. And in fact, if they're 70 and a half, it's going to be example number 2. They're not going to have an RMD, but they can still transfer $100,000. So again, we can give before, beyond, or without a required minimum distribution. Income taxes have to be paid on this money sometime unless it's transferred to charity. Tax avoidance through the QCD is more efficient than a tax deduction, and it is much, much more efficient than an unused tax deduction. If they're not itemizing, we definitely want to give this way. So do keep this in mind for any clients that are making charitable gifts. And as I mentioned, you must first convert other types of qualified plans to an IRA rollover. Any RMD in the year of conversion must be paid out. So we want to convert prior to the first year of RMD. So start talking when your clients are approaching age 70 and a half. Don't wait until age 72 for this rollover. So again, required minimum distributions are now back. The CARES Act stuff is all expired, but you can give more than your required minimum distribution. I do always want to provide you with little wonky things you can do in unusual circumstances. Here's my next example of a wonky little thing you can do. As I mentioned, the IRS does not allow one person to simultaneously be putting money into an IRA and taking a deduction for that, an above the line deduction, and pulling that out as a qualified charitable distribution in the same year. However, if you have, let's say, a married couple or any other partners that are sharing their financial resources, if you have that married couple, you can do this where one spouse, who is the earned income spouse, is getting a deduction for putting money into their IRA, and the other spouse, who has reached the age 70 and a half, is taking money out of their IRA to make a qualified charitable distribution. If you've got clients who say, yes, I have earned income, but I don't want to take that above the line deduction for putting more money into the IRA because I've already achieved my retirement planning goals. I don't want to be stuffing more money into the IRA, but they're making charitable gifts. Hey, here's a way where we can actually get an above the line charitable deduction for their charitable giving without changing their combined IRA retirement account levels. So we have one spouse is putting money into, let's say, her IRA. The other spouse is QCD, removing that money to the charity from his IRA. The combined levels of those retirement accounts aren't changing, but we're essentially getting an above the line deduction for that charitable transfer. So that is a little wonky possibility you have if you've got someone who is has earned income, but is not putting that money into an IRA to take that above the line deduction because they're saying that they don't want to increase their IRA holdings, but they're also making charitable gifts. If they're at this age, we can do it this way, where the two spouses can break this up into two parts to get that above the line deduction without changing the amount held in the combined IRAs. All right, now let's talk about estate planning. A lot of people think, oh, I don't need to worry about estate taxes until I've got that $12 or $24 million estate size. I'm not there. I don't need to worry about it. You actually still do need to worry about taxes in estate planning, just not estate taxes, but we still need to worry about taxes in estate planning. And it starts with this. Retirement plan assets inherited by non-charitable beneficiaries are reduced by income taxes. So let's look at a quick example here. Suppose we've got a client, they only have two assets. They've got $1 million IRA and $1 million house. They want to leave half to a child and half to a charity. Does it matter which goes where? Now, if you're in the mindset to say, oh, no, it's not $12 million, we don't need to worry about taxes, you'd be wrong. Let's see what the difference is. Let's do it wrong. On the left-hand side, we're going to do it wrong, okay? We're going to send the house to the charity, and we're going to send the IRA to the child. Just to make it an extreme case, let's say that child is at top tax rates, not only federal, but let's put them in California and put it at those top tax rates. That means that $1 million that went to the child now gets cut down to less than half of that because of taxes. You think you don't need to engage in tax planning just because your estate's not $12 million? Think again, you've just lost half of that transfer to the child, more than half, because of taxes. Worse than that, of course, the Secure Act now requires faster withdrawal. We've got to pay those taxes within 10 years. And now it's gotten even crazier with the IRS issuing their recent regulations that we're going to kick in those RMDs with that air right away. And they're going to have to start pulling that out from year one, paying those taxes even earlier. So these things have gotten more painful and consequently something we want to avoid. Good news, this is an easy thing to avoid. What do? Well, we do the right-hand side, which is we send the IRA to the charity. Charity is just as happy with that IRA as they were with the house. $1 million IRA is not going to be reduced by any taxes for them because the charity is an exempt organization. They don't have to worry about those taxes. We send the house to the child. They don't have to pay any income taxes on that. This is not income in respect of decedent, so we don't have to worry about that. They keep the full $1 million. Now, if we are naming the charity as a beneficiary, we do want to name a public charity. We could also name a private family foundation. That's fine. In fact, we could even name a charitable remainder trust as a beneficiary of that retirement account. And in fact, we can use that as a way to stretch out the payments going to the heirs beyond 10 years by naming a charitable remainder trust as the beneficiary. There are a couple of beneficiaries that you want to be careful with. We would not name a charitable lead trust as a beneficiary because charitable lead trusts are not exempt entities. So they're going to have to pay those taxes. So that's a bad strategy. Also, you have to be careful if you're naming the estate as the beneficiary with instructions for a charitable gift in the will document. It's not that it's impossible. It's just that you must have sophisticated counsel in drafting these documents to make sure that only that IRD asset is going to be going to the charity, that it's segregated, because otherwise the estate is going to have to pay those taxes from the IRA account. One thing very important to keep in mind here, and this is an often misunderstood issue, that can confuse people. Please don't become confused by it. What is the problem? Well, it is this technical designation that charities are not designated beneficiaries, and consequently, they might accelerate the RMDs for the other beneficiaries. This is a problem with so many solutions. It is absolutely not a problem. What do I mean by that? Well, let's start with the simplest approach. As long as you pay the charity their share before September 30th of the year following the year of the participant's death, this rule does not apply. There does not exist that I have ever seen any charity in the country who, learning that they've been named as a beneficiary, will say, no, just keep it in the account. Don't write us the check. Every charity wants the money now. So consequently, charities want that to be paid out. Just pay the charity out their share, and you don't have to worry about any of this designated beneficiary issue. It has no effect on any of the other beneficiaries as long as you get it kicked out. You know, there's some other ways to do it. The beneficiaries could separate the accounts by the end of the year following the participant's death. I don't know why you'd want to do that. Why not just pay out the charity? But you could. If the spouse is the beneficiary, you could simply roll the spouse's share into their IRA. Or if you want to get really sophisticated, you could go ahead and separate the IRAs into a 100% charitable one that has only a charitable beneficiary, and 100% one that has no charitable beneficiaries, just for the heirs. And that way you could sort of coordinate your RMDs with your estate planning as to how much you want to have left for each. That's fine as well. But again, if you ever run into this, somebody saying, oh, no, you can't name the charity, it's not a designated beneficiary, it can mess up the required minimum distributions. You know, the answer is, oh, no, there's 100 different ways we can get out of that. Well, literally there's 4, but just pay the charity out their share and we don't have to worry about this. The fourth suggestion is to give retirement RMD. Okay, so we've just covered this. Give retirement RMD first and more at death. The fifth suggestion is to take deductions today for transfers that will take place tomorrow. Now, let me share with you a little known technique that might become useful for you and could actually pretty dramatically increase your assets under management. So this technique is called a retained life estate deed. So basically what it is it just donates the inheritance rights to any piece of farmland or a personal residence to a charity. Now, this is different than a will because once you donate those inheritance rights, you can't change your mind. It's not revocable. And also, this is different in that this is done by recording a deed. Nothing complicated about the deed. It's just the same as can be the same as any other deed. You simply, in the line where it says it's from John A. Donor, transfer to John A. Donor for life, remainder to, and you name the charity there. That's all there is to it, right? If I charge by the hour, I would starve to death doing remainder interest deeds because it's just literally one line on a deed. You record that and you have made that transfer. Now, donated inheritance rights to personal residences or farmland using this kind of a deed, well, it creates a tax deduction. Little known approach, but it creates a tax deduction. Because you can't change your mind, you can take an immediate tax deduction right now this year for donating the inheritance rights. By the way, this not only works for any kind of personal residences, that includes, say, for example, second homes, vacation homes. It even includes if a client has a boat with bathroom, cooking, and sleeping facilities, as long as it is used occasionally by the donor as a residence. Now, here's the thing to keep in mind. The size of this deduction depends upon the interest rates. It is very interest rate sensitive deduction. Let me give you an example to show you how powerful that is. The charitable deduction for a remainder interest deed with retained life estate in, let's say, $1 million of farmland for an age 55 donor. You can see how with the lowest interest rates, which is back in November of 20, that would create a deduction of over $900,000. With the highest interest rate, it would create a deduction of $122,000, just over. Now, here's why this is so important right now. Notice, if you were to make this transaction with a 2% rate, you get a deduction of $616,000. If you make this transaction with a 3% rate, you get a deduction of $494,000. Now, why is that such a big deal? It's such a big deal because next month, the rate is 3%. Right now, and until the end of next month, you can still use the March rate, which is 2%. So this is not a hypothetical comparison here. This is a comparison because our interest rates are spiking right now. This is a comparison in what your client could get as a tax deduction, depending upon whether they're able to close this by the end of next month, or if they wait until they have to be using that May rate. Remember, you can use the current month's rate or either of the previous 2 months' interest rate, and you select the one that's most favorable for you. Now, if you really want to get on the ball and you record this deed by the end of the week, you could still use the February 1.6% rate, but I don't know that anybody is fast enough to be able to do that. So if we're looking at closing this transaction before the end of next month, the difference between a $616,350 tax deduction and a $494,000 tax deduction. So this is urgent, urgent, urgent. If you have any client that this might be a good idea for. So what we're trying to say here is to lock in the bigger deduction by donating the interest rates when we can still use that lower interest rate. And I need to add in one more bump on this because we're now going up to 3% next month. So just as a quick comparison, leaving land to charity by will, it is revocable. It does not generate any income tax deduction. If we do it through a retained life estate deed, we can't change our minds. That's why we get that tax deduction. And by the way, this is going to massively increase the donor's available cash because it creates such a massive tax deduction. By the way, if you're interested in these or any other strategies, I have put into the chat links to my book on this, also a series of 65 plan giving videos, some of which cover this strategy. All right, let's talk about some other strategies. We've got charitable remainder trusts. Charitable remainder trusts generate an immediate income tax deduction, even though the donor can manage assets and receive income for life. So the idea is we take an asset, we set it aside, put it into our trust basket. We can then sell it with no capital gains taxes, take payments for the rest of life on that amount, unreduced by those upfront capital gains taxes. Anything left over at the end of life goes to charity, and consequently, we get an immediate income tax deduction, even though the transfer doesn't take place until the end of life. There's also a thing called a grantor charitable lead trust, where we take our asset, we put it into the trust basket. That trust will then make payments to a charity for, let's say, the next 10 years, 5 years, 10 years, 20 years, whatever we want it to be. And then here's why it's a grantor charitable lead trust. Anything left over comes back to the donor. Now, why do we want to do that? It's actually an income tax planning strategy because we can immediately, right now, today, take a tax deduction for all 10 or 20 years worth of that future charitable giving. So this is another instrument that is very interest rate sensitive. So notice if we compare a low interest rate tax deduction with the high interest rate tax deduction, it has an effect. So again, I know we're used to having the end of the year as our urgent deadline, but I'm going to say end of next month now becomes a more urgent deadline because it's the difference between using a 3% or a 2% rate that can make a big difference. By the way, if you need help doing these, iclat.net is a lawyer who does a high volume of these with a national practice. So the fifth suggestion is to take deductions today for transfers tomorrow. The sixth suggestion is to match deductions with Roth conversions. Roth conversions and charitable planning can work together to match income and deductions. Now, a Roth conversion is where we take money from a standard IRA, which is going to be taxable when we pull it out, and we transfer it into a Roth IRA, which is not going to be taxable when we pull it out. Now, the painful part of that is any of that money we transfer, we've got to pay income taxes on that immediately. Because we've got to pay income taxes on that immediately, it creates a spike in income. So we're going to look for some offsetting deductions. The reason we want to do this is, of course, that not only is that amount that we transfer tax-free when we pull it out, but all of the growth on that money throughout the years is also going to come out tax-free. So that's the reason for doing the conversion, but it creates a big spike in income, and it means, hey, we want to find some offsetting deductions. Planned giving, charitable planning is really good for doing that. Charitable remainder trust, lead trust, donor advised funds, that remainder interest deed in a residence or farmland creates those deductions. We've also got the flip side of that. Charitable deductions can be limited to 20, 30, 50, or 60% of income, depending upon the gift and the recipient. Now, we've got that additional 5-year carryover, but maybe that's not going to be enough if you've got a client with high wealth, low recognized income. They may be capped out of this. So there are cases where we say, oh, we're capped out of using those charitable deductions because of these income limitations. Well, how can I pull future income forward into the current year so I can use more of those deductions? Of course, with the Roth conversion. That's the best way to pull that future income forward. Just to say that we can use these things to offset themselves, each other, to balance these things out. So again, the sixth suggestion is to match deductions with Roth conversions. The seventh suggestion is to buy life insurance with the value of the tax deductions. Look, we've got all these wonderful charitable planning devices, charitable gift annuities, gifts of remainder interest deeds and homes and farms, charitable remainder trusts. They produce amazing tax advantages. They can reduce income taxes, reduce capital gains taxes, reduce estate taxes, but they also reduce the heir's inheritance. Now, how do we address that? Well, look, life insurance can help to offset that, can diminish that concern. Let's look at an example, and we're just going to look at federal taxes here for the moment. But let's suppose Priscilla here wants to sell $1 million non-income producing zero basis asset. She then wants to invest it in a diversified portfolio. She's going to spend the interest income of 5% while leaving the principal for her heirs. And let's put her at top federal tax rates. And we're just looking at federal tax rates here of capital gain, income, and estate. Now, if we go on the left-hand side, she takes that $1 million asset, she sells it. What is she left with? She's left with a $762,000 asset because she had to pay capital gains taxes. She can invest that remaining amount. At our 5%, it kicks off about $38,000 a year. And then the heirs receive the $762,000. But if she's in a taxable estate, that gets kicked down to about $457,000. Now let's look at what charitable planning does on the right-hand side. We take that $1 million asset, we first put it into the charitable remainder trust. Then we can sell it with 0 upfront capital gains taxes. So that means we've still got that full $1 million, still assets under management, completely intact. We are now making $50,000 annually, not $38,100, because we've kept that full $1 million intact. And oh, by the way, we also get a massive tax deduction on top of that. Depending upon the scenario, let's call it a $300,000 tax deduction worth $111,000 in reduced income taxes. So what do we do with that value of that tax deduction? Well, let's take it and let's use it to make an initial payment on a life insurance policy. Let's use part of that extra income that we've got, because remember, that full $1 million is still intact, and let's use that extra income to be making annual premium payments on that life insurance policy. Let's, of course, stick that into an irrevocable life insurance trust so we don't have to pay any of the estate taxes on it, and we get a pretty good scenario. The client gets slightly more income than they had before, even after making all those premium payments. The heirs receive about the same. In this scenario, we put it at a little bit less after taxes, because they're now getting the money from the ILET. And on top of that, we've sort of magically created a $1 million transfer to the charity. So if your client has charitable goals, you've been able to execute those with that $1 million. We can do this in a more simplified form. Let's say we don't have a client with the level of wealth that's going to justify the hassle of a charitable remainder trust. Let's just do this through that one-line deed, right? So John, age 65, at a 30% income tax rate. Let's say he owns $100,000 of farmland, or that's part of his farmland, right? We can break this up into however many pieces we want, which he would like to use for the rest of his life and then leave to charity. He also wants to benefit his heirs. What do? Well, let's just go ahead and give that remainder interest deed to charity, creates a deduction of about, let's say, $80,000, worth up to about $30,000 in saved taxes. And let's suppose that'll purchase a paid up policy of about $50,000. So we're doing the same scenario. John keeps lifetime use of the farm. The charity gets 100% of the farm at death, but the heirs are going to get that death benefit, so they're not left completely out. So again, we can use life insurance even if we're not in the super large, super complex estates as well. And by the way, as these interest rates fluctuate, the nice thing is this still works, because as the interest rates go up, the income tax deduction will go down, but so will the cost of purchasing that life insurance policy. So the things can offset, and this will still work both in a low and a high interest rate environment. So that's the 7th suggestion, which is to buy life insurance with tax deductions. The 8th suggestion is to earn more by avoiding capital gains taxes. And you've already gotten the sense of how this works, right? If you have a client holds a large, highly appreciated asset that generates little income, maybe it's developable land or a non-dividend paying stock. How can she convert it to income generating property? We do it the old fashioned way. We sell it. We get hit with the capital gains taxes, both federal, and then we're going to add state onto this in Illinois. But even just with the federal, we get kicked down. And so we don't have as much left to invest. The other alternative, transfer it into a charitable remainder trust, sell it with no capital gains taxes, and we can then earn income on that full amount and a lot more left to invest. By the way, this comparison, which you've already seen this same comparison, is one of the reasons why there was a lot of legislative talk about eliminating this. So again, don't use the end of the year as the deadline. I would do this earlier rather than later, because some of these really tax advantage strategies like this are at risk. The 8th suggestion, again, earn more by avoiding capital gains taxes. The 9th suggestion is similar to it, which is to grow tax-free. There are tax-free growth environments, and these can be very advantageous for not only for the clients, but also for those who are managing the money in terms of assets under management. The assets under management are going to grow much more rapidly if you are managing assets in a tax-free or tax-limited growth environment. Obviously, growth inside a donor-advised fund is going to be tax-free. Growth inside a charitable remainder trust is also tax-free. It's only the distributions out of the charitable remainder trust that are taxed. So, in other words, the charitable remainder trust works essentially like a traditional IRA. You don't pay taxes on any of your buying or selling or income inside the IRA or the CRT. You only pay taxes when you pull money out of that IRA or CRT. We can also do this with a private family foundation. It is tax limited. It pays taxes only at that 1.39% rate, which is a pretty affordable tax rate compared to what we would be paying outside of that environment. Look, I don't need to tell you how much faster assets will grow if they're in a tax-free environment, but that growth can dramatically increase assets under management. So we've looked at all of these different advantages. A charitable remainder trust increases assets because there's no upfront capital gains tax at the sale. There's tax deferred growth inside the CRT, just like an IRA. There's a massive immediate tax deduction. And if you're interested in assets under management, you can continue to manage those funds by naming a donor advised fund or a private family foundation as the beneficiary, even after the end of the client's life. Now, by the way, all of these tax benefits stacked up led one finance professor to ask a question, which is, will a maximum payout charitable remainder unit trust with appreciated assets give more after tax dollars to donors and heirs than simply doing the normal sell it, invest it with no charitable gift? So in other words, is it the case that the tax benefits of a CRT actually exceed the value or cost of the charitable gift? Here's how he did the analysis. They did a Monte Carlo simulation of 3 million retirement lifetimes of age 60 and 55 female. He used the lifespan returns based upon the annuity tables, which is the right one to use. We actually get a massively overstated charitable deduction because the IRS uses just the normal life tables. Well, that's not, obviously sick people don't buy annuities, so that cuts off that whole end of the distribution. So the tax deduction is actually pretty massively overstated as compared with using the appropriate life tables, which are these annuity purchaser life tables. Again, varying returns, having a 2.8% of initial investment as the annual consumption, and using a 20% basis asset. Long story short, the charitable remainder unit trust outperforms the direct investment with no charitable gift. And when you're using the max payout charitable remainder unit trust, and by that I mean you're only making the minimum charitable gift, which has a present value of 10%. What we see is that plan is less likely to fail. That is, failure means you're not hitting your income goals than a direct investment. And it's actually even way more extreme than this, because when the direct investment fails, that means you are broke, okay? Charitable remainder unit trust, when it fails, that just means the income goes slightly below the target income level, because a charitable remainder unit trust doesn't run out. You simply get the same percentage amount of whatever is in the trust. It just gets a bit smaller. It turns out the heirs wind up better with the charitable remainder trust. The reason they wind up better in most cases is because the client is getting so much more income. If they accept that income from the charitable trust, but they still spend at the target amount, that extra amount is going to build up so much faster over time. And if you're worried about the volatility there, just buy a life insurance policy with it and use that extra income to make the premium payments, as we mentioned before. So that's the 9th suggestion, is to grow tax-free. The 10th suggestion is to maintain wealth over multiple generations. Look, keeping wealth together for many generations is difficult. The government takes a chunk of the assets at each generation. The rest is divided into smaller pools at each generation for each beneficiary. The government then takes a chunk of all subsequent earnings. At some point, you will have a greedy spendthrift heir that's going to blow that. Using a donor advised fund with a community foundation or otherwise, or a private family foundation, that's a big pile of money that distributes those charitable grants. That means you can keep that money intact. You're not going to get taxation at each generational level. Don't have to worry as much about those spendthrift heirs that are wanting to spend the money on themselves. Multi-generational management, hey, if it's an inheritance, you may not even want to manage that money because the pools get a lot smaller once you cut it up among all those kids. You get taxation at each generational transfer. All of the earnings are taxed and the risk of the spendthrift heir. Private foundation donor advised fund, there's no division at the end of life. There's no estate tax. There's no capital gains tax. There's no, or 1.39% income taxes. And you can also be more likely to continue to manage that money because you don't have to be any one of the heirs' number one advisor. You just have to be reasonably acceptable to all of the heirs. Some things you can do with the private family foundation. Private family foundations can hire an insider to perform necessary professional or managerial services if compensation is reasonable. So you can hire family members to do this kind of work. You can also reimburse the reasonable and necessary expenses, such as meals and travel to, say, a foundation board meeting for board members, also for junior board members that's the kids who are performing some functions in that role as they're being trained to be future board members. You can travel to grantees or potential grantee sites to investigate current or potential rewards. Private foundations allow for this unlimited, multi-generational, nearly tax-free control of wealth with an ongoing ability to provide insider travel and employment for professional management services. And they've got to focus just on the charitable desires of the founder. Now, some trade-offs between the donor advised fund and the private family foundation. Donor advised fund, way simpler, way cheaper to set up. There's currently no minimum payout. We expect to have control of grants, and with many organizations, investment management is still allowed by the financial advisor. These are legislatively newer, a bit more sort of fluid in terms of what's going to be coming up. Private family foundations are a bit more stable. Do keep in mind, if you want to use a donor advised fund, think about using that with the local community foundation. Especially when it comes to making those grants. The knowledge of the local landscape is going to be stronger with the local community foundation. They can serve as a partner for researching charitable opportunities. There's flexibility by naming their fund at the community foundation as the beneficiary so that you can update their charitable plan at the foundation without altering the estate planning documents. The estate plan just pays out to their fund, and it also allows for lasting endowments for their favorite causes and charities, knowing that their charitable intent will be honored. This is very powerful because a lot of times you have organizations that they don't want to do endowments themselves. They just want to spend the cash immediately. Well, you can work around that by setting up the endowment at the community foundation. A few final things I want to mention. We've got the non-grantor charitable lead trust. That is a strategy to avoid estate taxes. So it's only going to be for folks who are in that estate tax situation. How does it avoid estate taxes? Well, the reason it does is that you pay gift taxes on the amount projected to go to the heirs. You pay nothing on the amount that actually goes to the heirs. So if the actual amount is higher than the projected amount, you're going to get the benefit of that difference. And that projected amount is based upon the Section 7520 interest rate. So again, let's say we were able to use that lowest interest rate and we stuffed in $10 million and we're going to make these distributions to charity over 20 years. Well, we set this up so that the amount projected to go to the charity at the end is the amount projected to go to the heirs at the end is $0. So we pay $0 to set up that charitable trust, and any of that extra growth above the Section 7520 rate goes to the heirs completely tax-free. It's essentially, if somebody's already planning to do this kind of charitable giving, either during life or as part of their estate plan, using a zeroed out CLAT costs them nothing extra. right? It's a risk-free chance at making transfers to the heirs, but the power of this technique depends dramatically on the interest rate you use. If you close this transaction by the end of next month, you get to use a 2% rate. If you have to end up using next month's rate, that's a 3% rate, which means you're going to lose all of that benefit of the, you don't just have to outperform the 2% rate. Now you only get what you outperform of the 3% rate. So now is the time to talk to clients about this, because we've got this end of the month reality. Well, I have fulfilled my hour for your CE. You've survived. We're going to get an opportunity to go through any questions that you have. But I do want to mention to you, if you're interested in this charitable planning stuff at all, I share all my stuff for free. You want links to all of my books, slides, videos, papers, just connect with me on LinkedIn, and I will send you an inappropriately long response that will give you links to all of these things if you're interested in any of those things. So I'm going to go ahead and stop it there, and we'll take a look at the question. So Mike, I'll turn it back over to you for a moment.
Perfect. Thank you, Dr. James. That was great. We do have quite a few questions here in the queue, and I'll run them down the line here. We had the first question. If Congress passes deemed sales when making gifts, will charitable gifts be an exception?
You know, that's a great question, Neil. And I got to be honest with you. I retired from the business of guessing what Congress is going to do. And I'll tell you when this happened, because as an estate planning attorney, I sat through years of everybody saying, oh yeah, well, of course, the state tax is going to, the legislation is it will actually expire in 2010, but that's never going to happen. Congress will never let it expire just for a year and then come back a year later. And that's exactly what they did. It was insane. It made no sense. So unfortunately, Neil, I don't know what that will look like if it gets passed. After I saw some of the proposals from last fall, I am now in the mode of praying for gridlock, which I think we'll just get more of that, because some of those proposals were really unhelpful. Even if we've got some things in which they could be a little bit better, some of the things that were being suggested were quite concerning. So apologies, Neil, I don't have a prediction on that because I've gotten out of the prediction business.
All right. Second question related to QCDs. So, do all states with estate taxes allow the QCD?
Yeah, good point, William. So the QCD is actually a federal tax, and so it's driven by it avoids federal income taxes. It's also going to avoid those state income taxes. I'm not familiar with any states that don't allow a QCD to avoid the state income taxes as well. However, I will say that this is actually not an estate tax. So we don't have to worry about estate taxes with the QCD. The QCD is a way to avoid income taxes. And as far as I know, there's no states that create any exceptions to that for the state tax level.
Great. One follow-up on the QCD question too. Could you just speak really briefly on the status of Secure Act 2? We spent some time talking about the deduction or the timing for required minimum payouts and all that, and people taking distributions. I thought it did pass the House. Is there any chance of that happening? Have you seen?
Yeah. So again, Mike, you're making me violate my cardinal rule, which is predicting what's going to happen in the future with Congress. So I'm just going to wait and see. It keeps me busy enough just dealing with laws that actually exist. I'll let other people sort of focus on what's coming down next on that. So apologies that I won't jump into the speculation game even midway through the process, because things can change pretty dramatically along the way in that process. I mean, honestly, like we've seen cases where, believe it or not, with the Pension Protection Act, there was actually, and this is years ago, there was actually a provision in there to require a distribution out of donor advised funds that was in there until like literally the last 48 hours that got pulled out. So, I mean, I'm just not going to be in that prediction business.
Fair enough. Wanted to raise it because I'm sure a couple people had questions about it.
Sure. I do too.
Here's another one. Have you seen any increase in the use of cryptocurrency to fund charitable giving?
Yeah, so a great point, Alice. So here's what we see. Yes, cryptocurrency, appreciated assets. We want to make these gifts rather than cash. And there are now a number of donor advised funds that will accept cryptocurrency for folks wanting to transfer that. Now, I will say we're not okay, so it depends on how you define an increase, right? If you say compared to previous years of crypto donations, are we seeing more? Absolutely. You'll get these crazy charts showing crypto is spiking. It's, it's going off the charts. But if you compare it to like, the real things like securities and real estate, it's not making much of an impact there. And a lot of that is, frankly, is just, look, there is a life cycle for charitable giving. Major gifts tend to be made by folks who are 50 and above. Okay. Look, and I know we all love the stories of the, brand new young wealth and, the guys that are much younger that have that sort of thing. Look, if you're at a charitable institution, you take all those people under 50. I'll take everybody 50 and above, and I will crush your results because that's just the nature of it. That's when people tend to make these sort of important, meaningful, one-time life investment type gifts. Crypto assets tend to be held by a younger group. Although that younger group, they may be charitable in terms of making gifts out of their disposable income, they haven't actually shifted to where they're looking at their wealth as being donation relevant. So we actually don't see those big transfers yet. I know it's the shiny new thing, and I know that it is increasing relative to where it was in the past. And obviously we want to deal with that, especially because if some of these things are treated as collectibles, wow, we've got an even higher tax we've got to pay on that capital gain. And so we want to avoid that by making those gifts. But so I would say, yeah, it's growing. It is interesting, but it's still not up with the big boys of the securities and real estate.
Thanks. This is the last question. I know we're getting close to the end of our time. Is there any concern with drafting a residuary gift 50% to a DAF not to exceed $2.5 million with direction to fund the gift with IRD assets?
So again, if we're drafting if we're drafting an estate document and we we certainly want to make sure that that if at all possible, we can ship the IRD assets to the charity. Now, the safest way to do that, of course, is that that we have that the IRD assets themselves will have that beneficiary designation on them. So it goes directly from, let's say, that IRA, 401k, 403b, whatever it is, it goes directly to the charity. I'm just going to say, like, it is possible, but you do have to be very careful in the drafting, and especially when we start pulling that out of the residuary, rather than making that drafting that as a specific bequest that is specifically of that item. Again, you don't want to get over into that gray area where you could get a fight from the IRS that says, no, the estate needs to recognize that IRD. We're not going to let you to protect that. So I'm not saying it's not possible. I'm just saying we've got to be very careful. We want to make sure we have some kind of solid backing on the very specific language we're going to be using in that estate document to make sure that those assets are segregated and that we're not dumping that into the estate itself and then pulling that gift out of the estate, because that makes me very nervous when we start doing it that way rather than segregating those assets.
All right. Well, those are our questions, and we have reached the end of the hour. As we wrap up, I want to once again extend our thanks to Dr. James for being with us this morning. It was a great presentation, Dr. James. Thank you. We sincerely hope that all of you enjoyed the program and can utilize some of this information for your clients. Please reach out to us if we can help here at the foundation. We're here to be a resource and assist you. You can learn more about us at depagefoundation.org. Also a reminder to please complete the brief evaluation that should pop up on your screen after concluding the webinar. You'll need to submit this for those of you seeking continuing education credit. And then lastly, we will have a link of a recording to today's webinar available, and we'll also be posting it on our YouTube channel. And then also just want to thank Kate Balswitz, our Assistant Director of Donor Services, for producing and organizing today's webinar. Really appreciate it. And if you have any questions about or trouble getting materials, you can contact her at kate@depagefoundation.org. Thank you all for being with us and enjoy your day.